America's largest department store chain, Macy's, made headlines when the WSJ reported that it had received a $5.8 billion takeover bid from an investor group made up of Arkhouse Management and Brigade Capital. Macy's has previously rejected takeovers of this kind, making many wonder if it'll be the same case with this one. However, these doubts didn't stop the stock from moving, jumping by nearly 20% on the news. The bid raised many questions surrounding Macy's future, the valuation of its assets, and the goals behind the takeover. That's why in this video, we'll cover everything we know so far about the bid and the goals of the investors behind it, and weigh up the likelihood of Macy's rejecting or accepting the deal. So stay tuned. Welcome back to PST Markets. An investor group consisting of Arkhouse Management, a real estate investing firm, and Brigade Capital, a global asset manager, jointly made a $5.8 billion offer to buy department store chain Macy's and take it private at a valuation of $21 per share. The investors already have a large stake in Macy's through Arkhouse managed funds, and they believe that Macy's is undervalued in the public markets. According to a WSJ report, they have also indicated that it would be willing to raise its offer. The report also revealed that the group has the support of an investment bank that wasn't named. Still, it has provided a letter supporting the group's ability to raise the necessary funds to complete the deal. As for Macy's reaction to the offer, all we know is that the board of directors met to discuss the offer, but it isn't clear how they feel about it. The $21 per share valuation is a roughly 32% increase from the price Macy's stock closed at on December 1st, the day on which the offer was made at $17.39. However, that is still a far cry from Macy's stock's peak in 2015, which was as high as $70 per share. This is a decrease of around 75%. So how did the stock of America's dominant department store chain drop this much? Macy's was once the biggest full-line department store chain in the US, with around 850 stores. It also owns Bloomingdale's, a higher-end department store chain with more than 30 locations, and a number of smaller shops under the two banners. Even though Macy's managed to survive the 2008 recession, it found it harder to get through the rise of online retailers. In 2016, Cowen and Company analysts said that they were more confident that online retailer Amazon would overtake Macy's in apparel sales, and soon after, Macy's announced it would close 100 stores within a year. In 2017 and 2018, Macy's announced more store closures as it lost market share to online competitors. In fact, the department store chain saw a 4.1% decline in market share in 2017, accompanied by revenues falling by $3 billion between 2012 and 2017. Then in 2020, as Amazon moved deeper into fashion and online retailers like Shein became increasingly popular, Macy's said it would permanently close 125 more stores. It's not just Macy's that struggled to keep up with the rise in online retailers. In fact, the department store sector as a whole has experienced waves of consolidation and bankruptcy in recent years. The troubles of the sector were made worse by the pandemic, and in 2020, JCPenney, Neiman Marcus, and Lord & Taylor all filed for bankruptcy, to later emerge as smaller or digital-only players. On the other hand, Macy's saw a near 75% decline in its stock price when the pandemic hit. Macy's now operates nearly 500 department stores, and the company's Q3 results show how much its stock was struggling, falling by about 35% compared with the 17% gains of the S&P 500. This followed a 7.6% decline in sales, with Bloomingdale, Macy's higher-end chain, also reporting a 3.2% decline. When news of the acquisition offer was made public, Macy's stock jumped by nearly 20% to around $20, making it clear that Macy's board now has a lot to consider. By now, you're probably wondering why a real estate investing group and an asset management firm want to buy a declining department store chain. They probably have no intention of reviving the department stores, since the department store sector has been declining for a really long time. When looking at the major stores' Q3 results, Kohl's recorded a 5.2% year-over-year decrease in net sales, and Nordstrom also saw a decrease of 6.8%. As mentioned earlier, Macy's net sales declined by 7.6%. Additionally, people are expected to abandon stores and malls, expecting 24% of retail purchases to occur online by 2026. The e-commerce market is also expected to total over $8.1 trillion in the same year, a nearly 30% increase from 2023. So what could the investor group be interested in? The answer to this question is probably Macy's real estate holdings. Back in 2022, investment bank Cowen valued Macy's real estate holdings in a range of $6 billion to $8 billion, which is close to the price tag the investment group is offering the company. Macy's has a really valuable real estate portfolio, highlighted by its iconic location in Herald Square in New York City. Various money managers and investors valued it between $3 billion and $4 billion in the past decade. It is likely that the investors are interested in selling some of Macy's real estate assets, as well as Bloomingdale's, which has also reported year-over-year sales declines. Another potential target for the investors could be Macy's Bluemercury, a cosmetics and skincare business that Macy's acquired in 2015 for $210 million and now has nearly 160 stores. However, it's probably unlikely for Bluemercury to face the same treatment as the department store chains if the acquisitions happen, since the chain is the only one under Macy's that is actually growing. It reported a 5.8% year-over-year sales growth in Q2 this year, followed by a 2.5% growth in Q3. This is thanks to the constant growth of the cosmetics and skincare industries in the US, which are expected to grow by 3.54% and 2.99% respectively each year until 2028. We can see now how much Arkhouse Management and Brigade Capital would benefit from the acquisition if it happens. But how likely is it for Macy's to accept the deal? This isn't Macy's first time being a takeover target. In fact, Canada's Hudson's Bay Co. approached the company about a deal in 2017, but it didn't happen. Most recently, in 2021, Macy's studied splitting its e-commerce operations from its stores, as many declining department stores did, but ultimately decided against it. It's also not the first time Macy's was targeted because of its real estate, as shareholder Starboard Value tried to push the company to spin off its real estate assets, including its famous Herald Square location in New York City, in 2015. When Macy's hesitated, Starboard sold its entire stake in the company. Additionally, Jana Partners, another shareholder, pushed for the e-commerce separation in 2021, and when that didn't work out, Jana Partners cut its stake in Macy's by 84%. So Macy's doesn't exactly have a history of entertaining such offers, and it isn't helped by the questions raised over the asset valuations. As mentioned earlier, Cowen valued Macy's real estate alone between $6 billion and $8 billion just last year, and the current bid for the whole company is below $6 billion. So why should Macy's accept such a lowball bid? Along with that, Macy's flagship store in New York's Herald Square is valued alone at $2 billion, according to Bloomberg intelligence analyst Mary Ross Gilbert. Gilbert also thinks that even this valuation could be low, given the development underway that includes a new office tower. It's also important to note that similar stores to Macy's rejected even bigger bids. In 2018, the special committee advising Nordstrom's board rejected an $8.4 billion bid from the chain's founding family. Additionally, Cole rejected a $9 billion takeover bid just last year, which indicates the hard battle Macy's potential acquirers would have to fight. Even though these takeover attempts have failed, could this one be different? Real estate valuations aside, Macy's primary business is clearly beaten down. Even though it recorded a $43 million net income in Q3, it suffered a net loss of $22 million in Q2. Both are stark differences to Q1's net income of $155 million. The company has been undergoing a turnaround effort led by its CEO, Jeff Gennette, and these efforts included closing underperforming locations, opening smaller shops, launching new brands, and modernizing the company's supply chain. However, the company's management clearly sees the worth in selling its real estate during a stagnation period. Under Gennette, Macy's sold some of its real estate assets between 2015 and 2016, including stores in Brooklyn for $270 million, San Francisco for $270 million, and Minneapolis for $59 million. Gennette is set to retire next year and be succeeded by Tony Spring, head of Bloomingdale's. This change of management and the possibility of going private after an acquisition might make Macy's more willing to sell off more locations. Another reason many think the deal could happen is that many new positions in OTM Macy's call options were opened between December 4 and December 7, a few days before WSJ made the acquisition news. In fact, someone bought $2,018 calls on December 5th but had zero volume before that date. One trader even managed to turn $70,000 into around $700,000. This was an impressive and eye-catching move, but it also raised alarm bells over potential insider trading, or if someone knew about the buyout bid before it was made public. Macy's took a long time to solidify its place as America's leading department store since its establishment in 1858 as a small dry goods shop in New York. However, the business has been declining for as long as a decade as consumers shift to online retailers, which are the future of shopping. So, Macy's might not be as exciting as a retailer anymore, but it still has a lot of potential as a real estate play, which could be why investors are offering it $5.8 billion. Whether that's a lowball offer or not, Macy's board will certainly consider it carefully, especially since it's operating in a period of stagnation amid other department store chains filing for bankruptcy. Even though the stock surged at the news, it could be short-term if Macy's doesn't accept the deal. Additionally, the company must weigh how disruptive a takeover process could be into the new year. For now, we'll have to wait and see how this unfolds. Well, that is everything for now. What do you think? Will this takeover happen? Will stock rise further? Please let us know what you think in the comments below. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.